Hi everyone, hope you're all well and welcome to this month's Zoopla report. This is where we dissect the latest Zoopla report that comes in every month, and this is going to run us right the way to the end of February 2022. It talks about things like the house prices, the growth, any falls. It also talks about the demand, the supply. So look, without further ado, let's tuck in. So look, as you can see by the graph and the charts of what we've got below, you've got an executive summary at the top. You've got here that the buyer demand remains unseasonably high. Demand for family houses more than twice as high as usual for quarter one. Now, typically, what we tend to find in the market is that after Christmas and New Year, we have a bit of a frenzy in regards to family houses. People want bigger. They've been at either family members' houses and realised that their property isn't up to scratch, or people have come around to their own house and they've realised it's not big enough. So they look for space. But that happens in quarter one. Or the first month, I should say, of quarter one in January. And then it dies down a bit, especially when the weather gets a bit colder, and then it picks up again in April when spring starts, although the weather's not too great at the moment. But yeah, when spring starts, typically, we tend to have a bit more buyer demand and a bit more appetite for people to simply get out and have a look. But the reality is, as we can see back in the Zoopla paper now, is that it's unseasonably high. It's continued right the way through quarter one. And because of that, it's bumped up average house prices again. So we're looking at 8.1% increase year on year to February, taking the average value to 245,000. Now, what does that mean for you as an investor or as a potential investor? Well, it's pretty straightforward. If the cost of the properties are really high, especially for first-time buyers, what do? Well, they rent for longer, and they try and save that deposit a little bit longer. So that puts more demand on rental properties, and typically the majority of rental properties you'll find are in city centres. Therefore, it creates more demand for those kind of properties. Therefore, the property prices in that area can go up because the yield is higher, so investors get involved. So the reality is I still foresee the property prices increasing, especially in city centres, because of the fact that the first-time buyers are not vacating the properties as quick as they would. Now, we know it in here. The reality is that typically we would do 12 months lets, and we'd have to replace that tenant at the end of the 12 months. We're now seeing lets for 2, 3, 4 years comfortably. So the reality is, guys, is that I still think that the property market has got a long way to go yet. Now, as we head back to the report, you can see that Wales has registered the highest regional price growth for the 12 month at 11.8%. London is obviously at the slowest at 3.2%. But the reality is London for me was done as an investment property area, a number of years ago. If you find things that are well below market value in London, it's still a great place to invest. But the reality is market value is just simply not there anymore. And the new supply of homes, this is a key for me, and we're going to sort of delve into a little bit more deeper here, but the new supply of homes for sale continues to build, albeit slowly, 5% on the average. Now, let's talk about the supply of homes. The reality is, when COVID hit in sort of March 2020, and we were on lockdown, no one knew what was happening. Construction workers, they literally downed tools. And after sort of 3-4 months of lockdown, they got back on site. But what happened to developers is their mindset changed. They finished the developments that they were on. They then started to get quotes on new developments, and then they thought, well, actually, if there's a second or a third lockdown, which was always in the offering, they thought, well, we're not going to start now, because if they go on to a second or a third lockdown, they've got a site which is halfway finished, and of course, if it's not watertight, then it can be weathered and there can be issues. So they simply decided not to start the new sites. So what happened is we then had a struggle or strangle on the actual supply pipeline. But then what happened is when we came out of the third lockdown, we then actually had the cost rise dramatically. We had issues with suppliers, we had, of course, energy crisis, we had oil prices increase, and of course that puts things like timber, metal, plasterboard, everything went up. Some things went up as much as 60%. So what happened is the quotes that they originally had 1-2 years ago were now invalid, and of course they're now quoted 60% more. So what happens? The profit margins go down. Now, just imagine that your build is going to be £10 million, and your profit margin is typically what a developer will look at the time was 20%. It's probably more like 15 now, but at the time 20%. Well, if your build costs have gone up 60%, then your whole profit's wiped out. So what basically happens is they just sat on it, and they've sat on the land waiting for the cost to come down, or waited for the prices to go up so they can sell it and they can make more money. So the reality is that there is still going to be this stranglehold on the supply, and I still think that this flow of supply, even though it's up 5%, I really can't see it changing anytime soon. And I think that's going to create the demand-supply imbalance, which is why we're seeing the property prices go the way they are. So as we sort of like head down, we can see that more sales were agreed in London so far this year than in the first quarter 2021, but I think that's going to be a given, especially where we were this time last year in terms of COVID. But again, we'd start seeing that the average value of a home is up 8.1%, as we alluded to earlier. But the key for me is, as we scroll down here, and we can, and I'll come back to the overall price in a bit, but as we scroll down and we start to look at how long it takes to sell a house, this is the key. So if we go back a couple of years and we're looking where it, the average time it was on the market was over 150 days, running from Feb 2020 right the way through to June. Then we obviously saw that the restrictions lifted in terms of the lockdown, and we saw it dip, but it was still sort of peaking up at over 80 days. But we're now seeing it down to sort of like 29 days, which is a ridiculous amount of days that it's actually taking to push on. So in terms of the days, and apologies, I've got something slightly wrong there. That it should actually say, it should be 50, 60 days, but it's now halved down to 29 days. This is actually the buyer demand on the left. 150, 175 is the buyer demand index. But the time it takes to get something sold on the market is rapid at the moment. You're talking 29 days to get something sold. Now, while that's great for sellers, it's an issue for buyers because they keep getting outdone. Take our industry, for example. If we have 10, 15 apartments in a development left, or in a boutique development for investors, typically investors could take their time, they could do a bit of due diligence. We do a lot of due diligence ourselves, of course, but sometimes investors want to do their own due diligence before they had time to do it. They simply don't. The time that it takes them to do their due diligence, they come back, they make an offer and it's gone. And what we're seeing now is offers aren't being accepted because they know that if the price is 200, an offer of 190, they'll wait another week and there'll be an offer of 200 there. So offers simply are being refused, and that's also keeping the prices buoyant. So the reality is that we're seeing great price, great strength in the market. And as we head back up, we saw at the top left-hand side of the screen now, you can see that the average home is 245,000. Now, as we look at what that's grown by over a 5-year period, 21.5%, that's the house price growth on average over the last sort of 5 years. Take that, if you got a property 5 years ago for 200,000, and you had an increase of 21.5%, but importantly, you had in the region of 5-6% growth and income. If you had an income of 5% year on year, and if you had growth of 5% year on year, and you're making 10% year on year over a 5-year period, you've got 50% or close to 50% pretty much. £200,000 property, that is a phenomenal return. You've pretty much got 100,000 back on that £200,000 property. And what's the reality? The reality is you probably only put down 50,000, and you probably borrowed 150, so you've made £100,000 on the back of your £50,000 investment. So that's what you can actually achieve in the property market. So all in all, we really expect some great gains in the property market. Again, even pushing forward, do I expect people to make 50% again over the next sort of 4 or 5 years? No, I think the growth is going to slow, obviously, but do I think that you can still get there in terms of your income? 100%. I think if you buy in the right places, and even if you sort of mix and match and do a few short-term lets in there, there's definitely room for improvement, especially within most people's portfolios. And of course, as we head down to the bottom and we start to look at, let's head up to the outlook slightly. The scale of demand means the pace of activity in the market has been maintained over quarter one. We still see the scale of demand consistent, and I just don't see the supply catching up. So I still think that we're going to see this carry on, if I'm honest. And as we head down to the city summary, you can see here again, it's still the same tried and tested cities. You've got Liverpool, Nottingham, Manchester, Leicester, Bournemouth, Sheffield. Even the top 10, the 10th place is 8.2%, the bottom is 10.3%. So you're only looking at a 2.1% difference, covers the top 10. So as long as you get in the right city, you're going to make great gains without a shadow of a doubt. And a lot of people are looking at minor imperfections in things. They're looking at things such as interest rate rises. They're looking at Russia, Ukraine, and although things like Russia, Ukraine isn't minor, we're not saying that's minor. We're saying that it has a minor effect on the property market. A lot of people over the years, and they bought 5-6 years ago, they bought when Brexit happened, the elections, all things like that. And the reality is, and COVID as well, we still come through it, and the property prices are still going up. So I would say overall, as long as you're looking at a 5-10 year plan, you should be really comfortable in the property market. So overall, I've got no doubt that it's still a great place to invest. Have a great week and have a great month.